button. So we're going to hit the record button here. And actually, let me put it on Facebook, to the closed group as well, so that people can have it on there. Not that group. Bear with me here. All right. I'm really looking forward to this panel. So I kind of know a little bit about where each one of you guys stand as far as what the market's going to do in 2019. And I wanted to make sure we had a good kind of mix of both sides. And so I'm really excited to have you guys on. The state. And go live. All right, so now we're recorded. We're live on the closed Facebook groups. That is awesome. I'm going to call your name out, and I want you to remember the next person that I call after you, because that's going to be the person you're going to turn it over to once you're done telling your information about your background. So the first person is going to be Jonathan Twombly. I'm going to have you get started and share us yours first, and then I'm going to have you turn it over to Jeremy Roll. And then, Jeremy, when you're done, I'm going to have you turn it over to Dino. And then, Dino, when you're done, I'm going to have you turn it over to James right now. And then if Josh joins us in the middle there, I'll just have you, James, turn it over to Josh whenever he's done. So thank you guys so much for taking some time to be here. I know this is a topic that a lot of people have questions about and they want to know a lot about. I have some questions that I've compiled, which I know you guys have had a chance to look at ahead of time to kind of see what some of the questions are going to be. But I will also be taking questions from the audience. And so depending on which questions come in and all that kind of stuff, I have a feeling that this one's going to generate a lot of questions, probably more than any of the other panels that we've done. But the panels from yesterday went really, really well. And we had a lot of fun on them, had a lot of content and value that were driven from it. And it was one of the biggest things that were talked about. So I'm looking forward to, even in the next multifamily summit coming up in June, to even doing more of these with different topics. So I'm going to have you go ahead and take it away, Jonathan, and have you get us started.
Hey, well, thanks, Dan. Thanks for having me here, and I'm excited to be here and to meet some of you folks. That I know a number of you are like Facebook friends of mine, but we've never actually talked before, so this is really a great opportunity. So I'm Jonathan Twombly. I run a firm called Two Bridges Asset Management in New York City. We do not invest in New York City. We invest down in Dan's neck of the woods in South Carolina. We're currently standing at 400 units in our portfolio. And as kind of a preface to where I stand on this matter, we're actually in the process of selling the entire portfolio. So with that said, I will then turn it over to Jeremy.
Thanks very much, Dan. Again, thanks again for having me. Really, really appreciate it. I'm very happy to be here. So my name is Jeremy Roll. I'm in Los Angeles, California. I'm president of Roll Investment Group. To be honest, most of the time I spend throughout my days finding investments for myself as a passive or LP investor in various syndications or managed opportunities. And multifamily is one of the many asset classes I invest in, although it's honestly one of my favorites. It's a lot more straightforward than some other asset classes. There's typical strong demand during downturns and a lot of other things I like about it. What I would say is that I have been, I'm pretty, it's nothing to do with multifamily, but I think that we're at the end of a cycle. I think all the asset classes are very expensive, including multifamily. I'm a very happy seller right now of multifamily and any other things, and it's very hard for me to find something that makes sense. So I'm very, very leery of the opportunities I've seen in multifamily and every other asset class now for the past year or two, and mostly sitting on the sidelines and waiting for a downturn for an adjustment in prices. And really looking forward to getting back into a lot more multifamily when I do that. Just to be clear too, I'm in about 7 different multifamily deals right now. I've been in over 15 to 20 over the past 10 years. I'm very active in multifamily. Just the timing right now is very challenging for me. So that's my quick overview. I'm going to turn it over to Dino.
Thank you. And I also wanted to thank Dan for letting me in, because I think I'm the only one that has, my name doesn't start with the letter J. So it's good to be here. My name is Dino. I'm CEO of Edified Equity. I'm part of a commercial multifamily apartment community acquisition and asset management firm. Last year, we did put together 4 syndications across 4 markets. We like the South, where we're able to buy, I crunched some numbers, basically on an average, we are picking them up at about $37,000 a door. So we acquire an asset, this portfolio. We, of course, use syndication. But it's kind of in my blood. I was raised by entrepreneurs and come from people who own single family, small multifamily, motel, develop self-storage. So I've been involved in this for most of my life. And with that said, I'll turn it over to James.
Great. Thanks a lot, Dino. My name is James Zhang. I was actually born and raised in Houston, went to school in Austin at University of Texas, and then I spent 10 years at GE Capital as a loan underwriter for their commercial real estate group. There, probably underwrote $750 million worth of commercial transactions, office, industrial, retail. And then the last 4 years, I've been at Old Capital as a mortgage broker and originated about $500 million in multifamily loans. And also in the last 3 or 4 years, invested in 21 properties across 6,000 units here in Texas and as a limited partner. And that's it.
So I did just give a text message to Josh. He had the time zones wrong, but he's going to be jumping on here in just a minute. So we'll have him, whenever he jumps on, I'll have him give an introduction as well. The question that I want to go around the panel and have you answer first is going to be about, will you be actively buying units in 2019? And answering that question, and then and kind of, maybe elaborating a little bit on it, but then well, let's just first do this. Instead of elaborating on it, let's actually leave the elaboration for another question that I'll have later on. And I want you to start off by just giving us yes or no as to whether or not you will be actively buying units in 2019. So let's go in that same order with Jonathan Twombly starting off.
No.
I would say, this is Jeremy, I'd say no, with the caveat that if there's a unique opportunity with unique pricing, I'd still invest for sure.
Undoubtedly, yes. James.
And I invest as a limited partner, and yes.
Great. So in one word, I want you to describe the 2019 market, and then I want you to elaborate on why you feel that way. So just give one word that would describe what you feel the 2019 market is right now, and then just kind of elaborate on that a little bit.
Same order still?
Yeah, I'll actually, from this point forward, we'll have you just kind of jump in and chime in, and then you guys just give each other an opportunity to say something. So it doesn't matter the order at this point.
Well, I'll give a hyphenated word, which would be holding pattern.
This is Jeremy. I would say overpriced.
This is Dino. I would say in one word, it's cryptic. And forgot, Dan, do you want me to expand on that?
Let's do the one word first,
Okay.
then you guys can go back around and do the expounding.
Sorry. James?
I'm going to go with softening.
Good. Let's go ahead and I guess we'll just keep with the same order. It's working pretty well. So
Okay.
We'll just keep the same order and have you give us the explanation.
Okay, so if it's me, so I share Jeremy's view. When I said holding pattern, what I meant was sort of holding at an overpriced level. I think that there's, the kind of economic news right now is very mixed. There's a real mix-up of kind of bulls and bears out there, really across every asset class. I'm obviously a bear in this market and pretty much everything else, but I don't think that we're looking necessarily to some kind of collapse in 2019 unless there's some kind of exogenous event that happens that causes the bubble. And when I say bubble, what I mean by that is kind of I think we're sitting kind of on a bubble of people not really knowing which direction sentiment is going. I think there's a lot of people like Jeremy and I who are bearish, who are kind of expecting something to happen. I think there are a lot of bulls who are hoping something is not going to happen. And I think if something does happen, that could cause the whole thing to crumble. But assuming that there is not any kind of event like that happens to pierce the bubble, I think we're just going to continue to kind of hang out in this overpriced, kind of era that we're in that's supported by just incredible liquidity in the market and a lot of capital really not sort of really knowing where else to go. So I think that will continue for 2019.
So before we go on to the next person on this topic real quick, thanks, Josh, for jumping on. Sorry about the notification there about the time zones there.
Central time zone gets me every time. Sorry, guys.
No worries, no worries. Well, why don't you first, before we finish answering the rest of this question, tell us briefly in about 1 to 2 minutes your background in multifamily investing.
Yeah, so I have an engineering background, like a lot of friends and colleagues I've met in this space. I was a rocket scientist. It's always kind of an inside joke. I came from rocket scientist. Now I'm a multifamily investor. But I started out like a lot of folks. I had a portfolio of single family rentals. And, one day kind of light bulb hit me that, the path to really scaling and growing a portfolio was through multifamily, just economies of scale, just the benefits that you get with multifamily and just things that everybody kind of already knows. And that was kind of my path. So.
Great. And then will you actively be buying units in 2019? Yes or no?
Yes.
And in one word, describe the 2019 market. Just one word.
Optimism.
Okay. No worries. That's okay. So Jonathan gave his explanation, and one thing I'll point out to you guys is if it would help from a quality standpoint if when you're not talking to just press your mute button, and then when it's your turn to talk, just go ahead and unmute your mic. So I think the next person in line is going to be Jeremy, and just so you know, Josh, you will go after James.
Great. So I was the one who said overpriced. That was my one word. So let me just kind of expand on it a little bit more. I've been investing for about 17 years, so since about 2002 and as an LP investor, and I've seen certainly one very major cycle, and I started right after, the dot-com crash purposefully. And real estate's cyclical, no matter which asset class you're talking about. That's just the way that it works, just like the economy. Not necessarily exactly in line with the economy, but it's cyclical. So let me just take you through what I perceive to have already occurred in this cycle. So between 09 and 13, I invested pretty heavily in multifamily. It was pretty obvious to me that the number one obvious asset class, and I certainly am not, this is the market speaking, not me, was multifamily, because there were a lot of people being foreclosed on their homes, and there was a lot more demand for multifamily at the time. Plus there was a downturn. People weren't earning as much, and multifamily was a better option for a lot of people just financially than single family. So fast forward to 2013, that's the first year I thought that the market was getting more expensive. Again, this is my opinion, but I saw it getting more expensive. What I can do, because I'm an LP investor, so I invest across a little bit asset class, I can actually shift when things get expensive. And my goal as an investor is to stay away from the crowd. So as of about 2013, I started to switch away from multifamily, not just that asset class, but that one in particular, because I thought it was starting to get expensive. And I've kind of watched it progress ever since. And by the way, I've probably made about 10 multifamily investments since then. It's not like I'm not investing in the asset class, but they all had to have been unique situations that were uniquely compelling to me based on the fact that I was starting to get a little bit shying away from that asset class. Fast forward now to 2019, that's 6 years later, we're into the what's going to be, by the way, the longest economic recovery since the 1870s. Later this year, about summertime. So we've got a very protracted recovery on the macroeconomic side. And long story short is that, cycles come to an end. And so if you haven't thought of it from a very high level, that's the way that I tend to see things, because I'm kind of in things for a very long term. So I look really high level. I strongly recommend you really think about that. And that's why I'm saying it's overpriced. And it's not just this asset class. I saw people shift away from multifamily to self-storage and other things. Mobile home parks are probably the last bastion of decent cap rate. Those got compressed in the last two and a half years, I would say. I've been investing in those since 2010. I watched that progress. And so I say overpriced because I've heard stories, and not just one, of people going into Texas and buying Class C multifamily properties for 5 or sub 5 caps, Class C, and not necessarily in an A market. In fact, I have people now that I know who are actually shifting strategy to buy Class A property instead of C property, because the cap rate spread is so small, less than 100 basis points, it doesn't make sense to them to buy Class C when they could buy Class A at almost the exact same multiple. And so when those things start to happen, and I'm talking about, this is not where I live in LA, which is the stories you typically hear here, right? 4 caps in LA, that's common. I'm talking about in Houston, in Texas, and other areas. So to me, the writing's on the wall as far as we are in pricing. And I tend to think of things kind of in a very long-term perspective. So I say overpriced because I'm just referring to where we are in the cycle. And I've got to be really careful with the way I invest, specifically because I don't usually invest in very heavy value add. I think if someone's doing more heavy value add, pricing may be a little bit of a different equation. I still think it's overpriced because you're still paying more of a multiple for the exact same property, regardless of how well it's performing or how much value you can add to it. But that's my long and short explanation of my thought of overpriced.
Okay, so my one word was cryptic, and I just want to first say I don't disagree with anything that has been said by everyone on the panel thus far, and that's why I said it's cryptic. I mean, I believe that done right, you can still come out on top, but based off of what the previous two speakers said, I also believe you can get yourself in deep trouble. There's no doubt about that. So it's all in knowing what you're doing and finding the right opportunities at large. So I'm not saying, and I said this when we did our teaser, on Facebook with Dan, I'm not saying I'm buying multifamily in 2019 and then zipping my lip. There's much more to it. So when I talk about the opportunity, I'm of course talking about the market, the asset, projected returns, what's happening there, the right team, the whole 9 yards. So here's what I would just like to share is stick to your conservative underwriting guidelines and your mandates. Be patient, look for undervalued, under the radar opportunities, don't over leverage, and manage efficiently. We play in the B and C class workforce housing. So this is work. I'm not talking about, subsidized Section 8 workforce housing where they're paying their own rent. It's the backbone of the economy, and we are supplying something that we have a large demand. I mean, the demand is outpacing the supply. So having said all that, again, I don't disagree. I'm just saying that if you're patient and you are getting views that are under the radar, and maybe it's you and one or two other groups. I'm not talking about buying off of LoopNet, that the opportunities are still out there.
All right. Thanks, Dino. My word was softening. So, the nice thing about being an LP like Jeremy is when you get to see 21 properties every month in their P&L. So rent growth is softening across Dallas, Austin, San Antonio in the properties that I'm invested. I would say employment growth is also decreasing slightly, and supply is still pretty high, especially here in Dallas, where I am. But it is softening a little bit. So instead of the 3, 4, 5% rent growth that you were getting maybe in 2014 and 15, you're closer to probably that 2% number here in Texas. And a lot of times it comes back to sort of relative return. So what other deals are you going to invest in with your money? And so a lot of people that I work with, they're raising money from doctors, lawyers, accountants, and their only other option is really, okay, I can put it in the stock market and that's about it. So they are not raising money from somebody who has 500 investment opportunities. They're typically, multifamily is easy for them to understand. And actually, when I was at GE Capital, when we went through the downturn of sort of 09, 10, and 11, we took back a lot of properties across office, industrial, and retail. But the two asset types that we did not take back were multifamily and self-storage. And so when you start looking at during this time when everyone thinks the market is at its top, if you have to get a yield, whether it's 5, 6, 7%, let's say cash on cash, how else are you going to do that? And one thing people haven't mentioned yet on this call is really the tax change last year and the amount of bonus depreciation that can be taken on these multifamily properties, especially existing properties now that you might invest $100,000 as an LP and get a pretty large, negative on your K1 at the end of the year, which can materially impact the returns for some people. And so that's just another thing that I think is keeping this market going. Josh?
Okay, so my comment is really, so I don't disagree either that prices are definitely getting up there and getting heated. However, I think it's important to realize that everybody operates an asset differently. The way that I would operate an asset versus the way another operator would run an asset could be the difference between 1 and 2 points on a cap rate scale. So for instance, when we're looking to take over property, I might see something that's, it's priced at a quote unquote 6 cap, right? But if you actually break down the T12 and you dive into what his categories are, there might be some categories that don't apply for that owner that might apply to you. So if you are taking it at face value and you're running it like, I've seen many operators run it, which is a great model. It works fine, which you have a third party management, and they have their own set of buckets for expenses where things are going to fall into that, right? It's really not going to deviate from that. Versus the way that we run it, so our company has Greenline Management within our asset management division, and it operates basically, it serves solely to manage the properties that we own. So there's a lot of things that we can control in those buckets that might make a 5 cap for most people turn into a 6 cap. So I guess I'm just want to throw out there that there are some deals, depending on who the operator is, that can make that deal become a 6 cap. Now, we all have to still keep in mind that when you come to your exit, you then have to cater to your potential buyer, right? So just because you can run it at a 6 doesn't mean that you're going to be able to sell it at a 6, right? Because they're going to underwrite that property based on how they would be able to run it. So we're still very cognizant of that. But as far as being able to find opportunity, run it very lean and very efficiently, because we can control a lot of things in-house, we're still seeing deals that make sense. So I guess that doesn't really have anything to do with the overpricing, the debate going on right now. But I will say that depending on the operator, you can still find the deals if you know how to run them.
All right. So the next question that's going to be coming to you is going to be about in 2019, what markets would you suggest that should be? I want to really know from you, from what you guys are doing. So, which markets are you watching? Which ones are you investing in? If for those of you who are actually investing in 2019, and then which ones would you suggest avoiding, like your top markets to avoid?
Is this you asking me? I mean, so this has to come with the caveat that I'm not actually investing. I don't plan on it unless something really unusual happens. But I continue to look at the South Carolina market. It's a market I believe in long term because of the demographic situation there, and the businesses that continue to move in. If I were to advise somebody about sort of what they should be wary of, I think I would be very wary of markets that look cheap on a relative basis if you compare them to other markets that are actually expensive compared to themselves. And what I mean by that is places that you'll see a lot of on like Bigger Pockets and other forums where people are investing in places like Cleveland or Buffalo, really distressed cities that are literally hemorrhaging population. I mean, people can't get out of those places fast enough. And people go in there and they buy a deal at a 10 cap and they think that they're getting a really great bargain. And the fact of the matter is that in normal market, that could be a 12 or 15 or even a 20 cap market. So, all they're doing is they're comparing that to the 5.5 cap C deal in Dallas and thinking like, hey, 10 cap is awesome. I'm in on some secret that nobody else knows about. It's just not true. Everybody knows about the market. They bid it up to 10 cap. And when the economy goes south, that is going to be, those kinds of markets are going to be the first place to get hit. And what I foresee happening if things really turn badly, I watched this sort of the reverse of this process when I first got into the business, which was back in the the early part of this decade. I was here in New York trying to raise money for deals in South Carolina, or even before that in places like Texas, and I would get laughed at. People would say, "Why on earth would you buy anything in Texas or South Carolina or someplace like that when the recession happens? You're going to get your head lopped off." And over time, as the foreign money poured into New York, the New York money started going into Charlotte, and the Charlotte money went into Greenville, and the Greenville money went into, to Gaffney. I mean, these are probably markets that only Dan knows what I'm talking about. But, you saw that process happening, and everybody's chasing yield. Some of the money started, you had LA money going into places like Cleveland, right? And when the flood of loose money starts to turn, the tide is going to go back exactly the opposite. So all the money is going to start fleeing from these markets with bad demographics and bad fundamentals and bad economic stories, and flooding back. There's going to be a flight to safety, and it's just going to go right back up the ladder. So I'd be very wary about those kinds of markets.
So this is Jeremy. So I actually could not agree more with Jonathan. I think what Jonathan just described is the idea that cap rates compress over the course of a cycle. And as I mentioned before, I mentioned overpriced because I'm concerned the cap rates are basically at their lowest point at this point, right? If not very close to that. And I couldn't agree more as far as people chasing yield. You know, that's a very common thing that happens. In fact, I've watched it throughout the asset classes, what I described before. I actually described my progression in shifting away from multifamily back in 13 and looking at other stuff because of a progression of chasing yield into other things. And people chased yield all the way down to mobile home parks this cycle, and those got too expensive now, and those have now compressed to the point where people are now getting reticent about those. So it's kind of like that was the last bastion, so to speak. With regards to what I'm focused on, and so just to kind of put that to bed, do be very careful about those tertiary markets that, just like Jonathan said, you know, it's all about understanding where your market starts from and ends and can potentially go back to, right? I'll give you guys a really quick example that some of you might be very surprised to hear. Back in 2013, I invested in probably a 200-300 unit, very typical garden style Class B multifamily deal in Mesquite, Texas, which is actually in the greater Dallas area. Really experienced operator, over $1 billion in multifamily under their management at the time. They'd already been through a cycle. We actually bought that building at an 8.8 cap. It was actually a 9.1 after we did some final negotiations, but call it an 8.8 cap on the trailing 12. It was probably 97% occupied. We did minor rehab on the turns, but it was in perfect condition. That building is, I don't know what it's worth today. It's probably worth a 5.5 cap or maybe a 5, or certainly 5 to 6, easy. What that tells us, though, is that building could go all the way back to a 9 cap. Okay, I don't think it's going to, because interest rates have compressed and they haven't gone back up to where they were. But the point is, maybe it'll adjust 200 basis points instead of 300 or 400 basis points. But that's what the risk is when you're going into any market. And so chasing yield, regardless of the market, just be very careful of it. So to answer the question, I don't honestly look at a market on an annual basis. I look at it on a much longer term basis. I look for general strength in economic growth, population growth, and some other things. So my answer to this question about 2019 is I'm trying to figure out where are the good markets for the next 10 years, because I tend to look at 10-year deals. And what I see, there's a few things that I see. Certainly I see retirees flocking to the South. If you look at the population migration trends, the number one projected state is Florida. Now, Florida has issues. It's got hurricane issues and other issues depending on the area. So you've got to be very careful on how you manage that. But if you can manage it well, you've got Florida and Texas, top two that are on my radar across every asset class, just because of where the population is migrating to. And there's also pretty strong economies in those states as a result of that. Just a very quick side note, you didn't ask, but same idea for asset classes. For me, the top 4 asset classes for the next 10 years, based on the population trends, are actually apartments, mobile home parks, because they tend to do well in downturns, and continuing not very strong growth in average household income. Self-storage, because that tends to do well in downturns as well. Although there's a lot of overbuilding that's taken place in the past couple of years. You have to be very careful now, but I'm talking about next 10 years. And senior living, again, for increased demand. So those 4, including multifamily, to me seem really obvious for the next 10 years. And I would say that if you're looking at cities, don't just think about this year, because you're going to be in that building. If you're a 3 or 5 year or 10-year investor, you're going to be in the building for years. So you've really got to think far down the road, because as we all know, this isn't the stock market. You can't just press sell it and get your cash in 3 days. It's not the most liquid of assets. So that's my answer to that question.
All right. Thank you, Jeremy. This is Dino. So in 2019, the markets to avoid is what we're avoiding. We don't underwrite anything in New York or California. I don't want to just throw a blanket statement and say, East and West Coast, but going to keep avoiding those for multiple reasons. And we're, just like someone mentioned earlier, we are avoiding markets to where that has already attracted the herd. We don't want to be, I've said recently, you want to be in Austin before it's Austin. Like I don't underwrite any deals in Austin. And again, I'm not saying that there isn't a needle in a haystack out there available, but when you factor in time, I think time could be spent looking at other markets that hasn't attracted the herd yet. So go secondary, where it's close enough to benefit from what's happening in the larger areas, and invest in under the radar emerging markets. That's really what's on our radar, and we go granular. So we don't want things that, you're hearing about on national news. Everybody's going to Texas. Where is that opportunity? And how do you know that there's going to be growth there? Chamber of Commerce type conversations, go local news. What do we know is going to happen versus speculation? So when you know those things are happening, how are people, how are the businesses getting along? What's the government saying about new highways and infrastructure? We really look at that at a large scale before investing somewhere. Be there before the boom so that when something happens, you're getting in the right place at the right time. However, having said that, you don't underwrite for the boom. If it doesn't work as is with stable underwriting, very conservative market growth, then you have no business getting involved in that opportunity. And then on the financing, I mean, going back to what Jeremy said, I agree there. You have to have a very favorable debt coverage ratio, number one. Lock in that debt for 10 years. We're not going to sell based on the calendar. We're going to sell based on opportunity. So when we, as a syndication group, when we show a limited partner an opportunity and the business plan is for 5 years, why do we have the debt locked for 10? Because in 5 years, if it's not the right time to sell, we don't have to. We can wait another 2, 3, or 5. And that's pretty much what I wanted to cover for that. I'll let James take it over.
Yeah, thanks, Dino. Hey, Jeremy, just Jeremy Roll. What was that property in Mesquite? Remember the name?
I have to look it up.
It's okay.
Yeah,
there's a couple properties that we just did a loan on in Mesquite. It was about 300 units, and it traded probably 90 a door for sort of a B minus deal. So just wondering. But in terms of investing in 2019, my focus is really DFW, Austin, and Houston. And the reason I chose those were really employment growth, which is leading to population growth, which will lead to apartment demand. And those are the 3 markets that I have spent the most time in. I was born and raised in Houston, went to school in Austin, and have lived in Dallas for 12 years now. So I think a lot of times, sometimes people forget that it is easier to invest where you actually know, what side of the railroad tracks you want to be on. And I think there's still a lot of opportunities in these markets. And I agree, sort of, Jonathan and Jeremy, Marcus and Millichap had a slide on their recent market update, and they had 60% of their transactions in 2018 were in secondary and tertiary markets. So people are going and searching for yield. And in a downturn, that liquidity is going to disappear. And so in Texas, that's really sort of anything outside of the Texas Triangle, they like to say, your East Texas or West Texas markets, those are where the liquidity is going to dry up, and there's a lot of volatility. So my investments are really in those major markets here in Texas. So turn it over to Josh.
All right, thanks, James. And let me know if my mic is still echoey. I heard some comments that you guys can't hear me, it's echoey, so just type in the box if you can't hear it. But I would have to actually agree with James. I'm also in the Houston market. Our company is in Houston. All of our assets are in the greater Houston area. And, other markets that we are really staying away from or anything, it really goes back to the basic herd mentality. You can apply the same metrics to the stock market, where anywhere there's a saturation of people chasing the same thing, you're going to get small little isolated bubbles in those local markets. So those are in general, those are markets we stay away from, but more based on our business model, we're in Houston because we know the area well. And like James said, within Houston, there's so many sub pockets of markets that if you really hone your craft and know your area as well, you can really know the difference between the property on this side of the tracks or the property on this side of the tracks. And so we have properties based on all sides of the tracks in Houston, and we know the pockets of areas to stay away from. So an investor that might be in California looking at, hey, check out this awesome 6.5 cap deal. It's over in this part of Houston. I might look at it and be like, okay, that's great, but I know why it's a 6.5 cap and everything else is trading at a 6 or 5.7. It's because the area is these are tougher to lease out. The properties built in that area in that time period have a lot more deferred maintenance typically than other pockets in Houston. So, for me, it's more of for our team, it's more of a grassroots view on what markets to stay away from, especially since we're, Houston centric. And, as we grow and expand and continue to grow our business, we will look at other markets, but we will apply the same metrics as any other market we go into. Is there a herd there? Okay, if there's a herd there, is there still more food left in that, or is it the end of the gold rush and everybody's chasing what's left? The grasping for straws of what's left. So that's how we look at it.
So I have a pop question for you guys. So this is a question that I know other syndicators have asked me how to respond to this question because it does come up, and investors are concerned about the 2019 market and what's going to happen in the softening of the market. And one of the questions that they ask is, if I don't invest in multifamily, because the reason why I invest in multifamily is because I don't want to be in the stock market, and because there's a softening of the market coming up, I don't want to be in the stock market because I'm not going to have that capital preservation in play. Where would you guys suggest, or not suggest, where are you investing in 2019? And even for those of you who are investing in multifamily in 2019, if you were not going to invest in 2019, where would you invest in 2019 if multifamily was not an actual asset that you were willing to invest in?
So we going back up to the top. I'm going to sort of answer this with a question, I guess, which is, one of the things that I don't understand about the way that it seems like most of the world approaches investing is, like, what is so bad about cash, right? So, cash is opportunity. There's very little that's as liquid as cash is. And if you're kind of anxious about where the market is going and you think that opportunity is coming, why would you not be stockpiling cash in order to be getting ready for those opportunities, particularly when we're in an extremely low inflation environment? It's like less than 2%. You're talking about minimal kind of loss to inflation if you're in cash, and you're at the same time like multiplying your opportunity to get in at the bottom of the market where you're going to make such good returns that you're not going to care about like the 4% that you lost over 2 years of holding cash or whatever it is.
Well, Jonathan, let me step in here for just a minute, because I think you're talking about somebody who just has, a bank account with a bunch of cash in it, or, whatever you're referring to, which is great. I would agree with that too. Like, why wouldn't you just let it sit there? But we're also talking about investors who are bringing money in off of a business or some sort of other entity or something, and they are building that cash up. And so if I just take that cash and just let it sit there, now I'm going to be taxed, and the government's going to take more of it away from me. So where is the advantage of actually just sitting on it and paying that 37% or whatever it is in taxes than to actually try to invest it into an asset?
Well, because I think that most assets, like Jeremy has said before, are overinflated. Whether you look at the stock market, you look at most other hard assets, that's what happens when you have 10 years of loose money from every central bank in the entire world. That asset prices are frankly, I think you are potentially looking at major losses if you invest that money in other things. So you might be worried about getting taxed at 37% on your 0.01 of interest. It's pennies that you're talking about, losing in taxes. But you could be looking at, like, say, even multifamily. One of the stats I read recently was talking about how great multifamily is in a downturn because it only lost 32% in the last. Talking about asset values, it was the best performing asset class in the downturn because it only lost 32% of value. Now, obviously, those are unrealized losses if you don't have to sell or you don't have to refinance. But if you're in a position of having to sell or having to refinance in the middle of that, you're talking about real money that's on the table. So you have to think of cash as an investment. I think one other option is maybe gold, just because it holds its value, and if we do get a bout of inflation, gold is always good. I really honestly can't think of what to put your money into that's sort of easily accessible to most people at this point, given where the valuation of everything is,
So, Jonathan, this is Jeremy, just to go down the line here. So, Dan, I get what you're saying about the taxing. I tend to be a very low risk, ultra low risk investor. So I agree with Jonathan. I'm actually happy to be sitting in cash right now and knowing I'm just kind of patiently waiting. I did this between '05 and '08. It's excruciating. I'm already over 2 years into an excruciating wait at this point, relatively speaking. Still making many investments that they got to be unique. So to answer the question, if someone is hell-bent on putting money to work, which I know some people always want to have their money working, while others don't necessarily have that perspective, I tend to find there's two different perspectives. But on the perspective of putting your money to work, I have two suggestions. One is either, whether it's multifamily or something else, look at a deal where there's some value add that you can actually bring in very quickly, because if someone's looking to do a 3-year value add plan, and liquidity dries up in a year from now, and you've got a portion of a construction loan that you're not going to get another tranche on, for example, that could be a huge problem. So something that has some value add potential that can be done very quickly, so you can add some padding into the value, so that when the values do go down, you're going to lose at least less money, at least on paper, and that you're going to be in a better position longer term regardless. So that's number one. And number two is, I would say, look at those areas that we talked about over a 10-year period. They're going to have stronger demand, because you're going to presumably sit and wait 3, 5, 10 years on a deal. Make sure you're in a strong demand area, both from an economy perspective and from a population perspective, where everything's going to be growing, so that you'll also be on the better side of the tracks when you come out of that, between the two. I personally am happy to sit around and wait. I'm not happy in that I'm not happy I have to wait. I'm actually a very happy seller right now. But my cash flow ball, which is all I focus on, is cash flow personally, and that ball is shrinking this year because there's stuff that's being sold and I'm not able to redeploy it as well. But to me, I know on the long term I'm going to be better. So to Jonathan's point, I'm happy to sit in cash. Another thing you can do if you're hell bent on putting money to work is you could do short-term hard money lending, or at least you're taking short-term risk. There's issues with that. It's absolutely a game of musical chairs in the end of the day, if you have a kind of what I call a typical market rate LTV these days. But Dan, if you're thinking like a 1031 scenario or whatnot, and you're really hell-bent on putting it to work, at least make sure you're going to go into deal with some value add to create some cushion and get into the right markets for the long term.
All right, this is Dino. So this is a tough question, for me to answer. Going back to what James said, we really haven't delved deep into the tax benefits. And so I guess if, when you look at multifamily at a whole done correctly, it has the ability to weather the storm. And then when you throw the tax benefits, the long-term financing, and you just weather it. And again, don't sell on a calendar date, sell on opportunity. It just makes it hard. But if you want to make my brain go there, I would agree with Jonathan. And for me, it would either be gold, or I would dig deep into learning, because this is not my forte, but I would learn the mobile home park aspect of the business. And not saying I would throw cash there. I need to take time to learn the ins and outs of it, but I think that there could be opportunity there. I like self-storage, but the truth of the matter is, I think when things get tough, people will go and get things out of storage and put it in their homes. So it's, that's easier to do than say, I'm not going to have a roof over my head. So gold or mobile home parks for Dino. Again, be patient though. I wouldn't just throw it. I would rather have the cash and make the right investment and let inflation do its thing than make a bad investment.
Guys, this is Jeremy. Can I just throw one little data point out for you guys? Because I actually have never invested in gold, so I'm a real amateur, but I've looked at some charts because I was actually thinking of getting some gold while waiting. And if you chart out gold, what's interesting about gold is that in downturns, what's happening historically is that gold actually goes down at the beginning of a downturn and then eventually goes up and actually then outperforms. The thing is, it goes down less than the asset classes we're talking about, that 32% number that Jonathan mentioned. So it might be considered a better way to not lose as much value, but do make sure you're looking at charts on gold to make sure you understand that it doesn't typically go up right away. And it could be better to buy the gold after the downturn starts than before the downturn, even though that doesn't sound like it would be right. Just, and that's not what I thought before I started to research it, before I went to invest. So just a quick side note for everybody.
I usually never talk about gold, but Tim Ferriss actually just had a guy on that I was listening to his podcast, and he said gold has the most volatility and the least absolute return if you look over the last 100 years, and no cash flow. And so similar to, I've listened to Jeremy on a couple of podcasts, and I've heard him talk about cash flow. So I could not be in gold personally myself. But I want to talk about a couple things. Dan, I didn't really understand your question, but I think based on the responses, I'm going to try to answer it. Jonathan, when you talked about timing, it is very difficult. Like, if people think this is the top, but then it's just as hard to call a top as it is to call a bottom. And so once the market does have a correction, it's going to be more and more difficult for people to invest in it, because they're going to say, well, why don't I just wait, right? In the same way that right now it's actually pretty easy to get a loan on multifamily properties. But when there is a downturn, leverage gets cut back. The amount of equity you have to put down gets cut back. There's a lot of things that people don't remember, I think, in 09 and 10 and 11, where deals were a lot harder to put together. And when the stock market is down as well, it is a lot harder to raise equity. And so all those things are sort of go against you in a downturn, and it makes it harder and harder. So I don't know when the top is going to be or the bottom. And so I've just been consistently investing as an LP. And I do feel that, having some diversification across markets and across your timing helps as well. So those are my two things. And then one more thing also on taxes. I work with a lot of people who either have 1031s, or they have businesses, or they have a very high income. And those things where, let's say, instead of paying the government 40% of your, let's say, $1 million that you made in 2018, they are investing that money so that that money is actually making cash flow this year versus the 40% that would have gone to the government. So one more nugget on there for you.
Hey, can I just jump?
Yeah.
I'm sorry to interrupt you, James. I just want to just kind of respond to something you said. So yeah, I agree quite strongly, actually, that it's impossible to time the market absolutely. But I do think you can get a pretty good sense of not necessarily where the exact top is, but when is a good time to sell, and when is a good time to buy, and when is not. And I think one of the things that I've been doing personally is I have a lot of people reach out to me who want to invest in deals with me, and I tell them just very frankly, like, hey, I'm really on the sidelines, but this is my plan. And I'm spending a lot of time sort of educating my investor base about what's going on, about my thinking, and about the opportunity that I believe is coming in the next couple of years, so that when it does happen, hopefully won't have that problem raising capital when the opportunity is really there, right? Because I'm hoping, sort of my plan is, and I might prove myself wrong, but that, by educating the investor base, they'll recognize the opportunity when it comes, and not be fearful and not be panicking about what they're seeing around them and what they're hearing around them about, how terrible real estate, is as an investment, because they'll be talking to all those people who invested at the top and have seen their investments crash. I want to prepare them for the reality on the ground. But I recognize what you're saying completely about the difficulty of raising capital. I've been there. This is I got started at the end of the downturn, and I definitely saw those things personally. So
yeah, this is Jeremy. I just want to kind of throw in 2 cents on that as well. If you're a syndicator and you're slowing down now, and you're wondering, okay, what do I do? Because I got to wait, and you're trying to figure out other strategies. What should I pivot? One of the things I definitely recommend that I actually seen one syndicator I've invested with who has over $1 billion in multifamily. I won't name them because this is like, their strategy. But bottom line is that they've been spending years building up their investor base, because they saw in the last downturn that the biggest challenge they had was raising equity on deals that they knew were really the exact right timing. And so they just didn't have a big enough investor base. They kept going back to the same people prior to that, were very successful in building their portfolio, and then fell short at the best time, both because people were scared and because people had less liquidity and had less wealth to invest at the time. Now they put themselves in positions where they actually have too many investors, but they did that on purpose, and they did it so that we're really well positioned once there's a next downturn. And so I'd strongly recommend, if you're a syndicator, that you, in thinking ahead, if you want to be able to take advantage of the next downturn, I agree 100% with Jonathan. Timing is very challenging. And by the way, typically stuff doesn't bottom out for a couple of years after the downturn starts. So you've got to be careful buying something right at the beginning of a downturn if you really want to optimize. But bottom line, there's just a suggestion of actually building up an investor base now in anticipation of be able to actually leverage the downturn whenever it comes in a couple of years or whenever it's going to be.
I think I'm last year. So just to get back to the original question, Dan, I think you asked, what would we invest in if it was not multifamily going into 2019? Was that the original question?
Correct.
Yeah. So, for me, from what I'm seeing, this is more kind of ties in where I think interest rates are going, but I still see plenty of debt funds and debt money out there that's way more prevalent than there ever was, especially in multifamily compared to 20 years ago. And so as long as that money is always trying to find a home, it's always going to be seeking to put that money to work, right? So the way that I see it is as long as interest rates, yeah, there's going to be a little bit of a coming up off the bottom, and even now they're cooling off again. But as long as this money is desperate to find a home, I don't think you're going to see a ton of pressure upwards in what operators and syndicators are going to see on their loans, and the fear of that causing asset prices to go all berserk. So for me, that means if I was not going to invest in multifamily, I would be looking at high yield funds. I guess I would even invest in the very debt funds that I try to get money from my deals for. So I think just to kind of answer the question, that's what I'd be looking for. I don't know if I'd be in gold. Basically, junk bonds, debt funds, anything that can give me a decent yield return over what the market, or again, if I can't be a multifamily, I don't really have a choice. So.
Yep. Good. Well, thank you guys for your insights on that. I do have a couple of questions that have come into a couple of people. So first one's to Dino. This question is directed at you, I believe. And the question is, I know real estate markets are more local based, but when we plug in lending piece from Wall Street, which is a globally affecting thing, it affects real estate as well as, regardless in which real estate markets or submarkets you're in. What is the panel's comment on this?
Okay, I'll go first since you think it might be geared
I think it came in after you were talking about some of the micro markets and stuff like that too.
Yeah. I mean, we stick to, don't get me wrong, we still have our underwriting guidelines and our mandates. So for example, if there's not a minimum of 250, 300,000 people currently living in that MSA, we're not going to underwrite the deal. If job growth isn't where we need it to be, if people aren't wanting to move there, we don't see the economy booming. So I'm not talking about going where, I don't know, maybe I'm exaggerating, but there's 3,000 people, in the city. So there's still going to be demand and supply. And for us, interest rates have been even recently have been in the mid 4s to high 4s in the markets that, we're looking at. We're primarily staying in the South. That's where we're finding these opportunities, whether it comes hand-fed from one of our property management companies or a broker that we've closed on deals with, in the past.
I would just add real quick, when you're looking at financing your multifamily property, majority of the deals that we do are Fannie and Freddie. And so for first, second, third time investors, you can get 75% leverage, non-recourse debt on a lot of these properties. But Fannie and Freddie, Fannie has pre-review markets, so that's one thing to watch out for. So that's going to limit your leverage in certain markets. And then Freddie Mac has a small balance program that, depending on the size of the population in that city, they might, instead of a 125 debt service and 80% leverage, they might be 75 or 70% leverage in some markets. So Fannie and Freddie sort of already have built-in things that are protecting investors and protecting the people who actually invest in those loans. So just wanted to add that piece.
So I have another question that came in that was directed to Jonathan Twombly. You mentioned the markets in South Carolina. Describe your overall feelings about the Carolinas long term, and what markets do you like in the Carolinas, and what metrics have drawn you to the Carolinas?
Well, I got started investing there in the first place because just sort of by way of backstory, when I first got into this business, I had a different partner, and we were looking at deals that were in Texas and Louisiana. And we had a plan at that time to start looking at other MSAs as well. And I just got lucky because the census data came out from 2010, right around there. And I just love digging into data like that. And I just started digging into the census data, and I wanted to find markets that were growing faster than the national average and that weren't so far from New York. And for me, Texas, it just was too far from New York. It's a real pain to get there from here. You can't just go down in a day. So when I used that metric, a few markets just jumped off the page at me. They were in the Carolinas, parts of Virginia, maybe Georgia, that were just growing at a fantastic clip. And I could literally go, I could fly down in the morning, fly back at night, and it was perfect. So for me, kind of the base, the first thing I look at is population growth. And even in those states, one of the things that you have to keep in mind is that really throughout the country, there is a big divergence emerging between metropolitan areas and things that are outside metro areas. And so within, even in South Carolina, you may have areas that are growing very, very fast. The cities around, say, Greenville, Spartanburg, Charleston, Columbia a little bit less so, but it's got some growth. And the rural areas where the population is just like, those places are hollowing out, right? So you want to make sure that you're in the right parts of the state. So I like Greenville a lot as a market. Spartanburg is good. I like it a little less. I think Greenville's got a more diverse economy than Spartanburg does. Spartanburg is very heavy into manufacturing. Spartanburg also has much higher taxes than Greenville, even though they're like 30 miles away. So I will be focusing on Greenville in the future. I think the growth is really great there. Obviously, you've got markets in North Carolina that around the Charlotte area, it's growing very well. Research Triangle, Asheville, growing very fast. But I think some of those markets have gotten really bubbly. I haven't taken a look at Asheville recently, but last time I looked, there are certain markets I call like the hedge funder markets, which I kind of like to stay away from. Asheville is a hedge funder market. Charleston is a hedge funder market. Those are the markets that, the hedge funders all own homes in, and they think, it's human nature. They know them, they're familiar with them. So they think they're safer and they bid them up. And the fundamentals may not necessarily support them. I think like in the case of Charleston, it's an absolutely great market and a wonderful place. I think it's overvalued, and it's been overvalued for quite a while just because of the attractiveness of Charleston itself. The population growth is really strong, but I think a place like Greenville is just as good, if not better, in terms of the underlying fundamentals. But I don't want to take up too much time because it's work.
Sure. I got another question here for Jeremy. It came in from Neil Ship. You spoke about looking at the markets that will be strong 10 years out. What are some of the metrics that you look at to identify those markets?
Yeah, I would say that's a good question. So I'm going to try and keep it really simple. The way I look at it is that it's projected population growth based on where people are demanding to move and local economies. And what I mean by that is that you can actually look at, I think, any state. I've invested, I think, in over 43 states. And I've learned so much in having traveled. And actually, sometimes I end up landing and have to drive 4 hours. And man, you see a lot of stuff when you're driving 4 hours in the state. And I'll tell you that, we talk about Texas, for example. Great example. I actually have some oil and gas investments, and I'll typically land in Dallas and drive to Midland, you can fly to Midland. Between Dallas and Midland, there's a lot of different things that happen, and then it gets kind of very quiet for the last couple hours. And so, just because Texas is a great state as far as the projected population growth and a lot of economic growth right now, it doesn't mean that every part of Texas is okay. And so the local economy is absolutely critical, making sure there's diversification within the employer base, understanding which employers are coming in, which ones have left, and taking a look at the general trend. I would certainly stay away from anything that's got a trend of either population flat for 10, 20 years or population declining. Understand that the population in the U.S. grows every year just organically. And so also from the economy perspective, one thing you could do is take a look at the current unemployment rate of an area versus the national average. And that's just very simple. It's simplified. It doesn't tell you everything, but it certainly tells you something if you're in an area where the national employment rate's 4 and yours is at 7, just making that up, of course. But you're still going to understand what is the underlying makeup of that local economy and where do I think that's going to be in 10 years. And if forecasting 10 years out from an economic perspective is very challenging right now. We've got, the internet and retail shifting. We have self-driving cars coming up. We have robotic automation coming up that could displace jobs in many different ways across many different industries. So I would strongly recommend you think, I actually read about 1 to 3 hours of kind of news and data every single day to stay on top of this stuff. And it's critical to kind of form an opinion about where things are heading and to try to match that up with where you're investing, but on a 10-year basis, because real estate, we're a very illiquid asset. And you've really got to think ahead. I mean, to give you an example, I've been thinking I've been investing in asset classes that would do well for a downturn since 2013. Not because I thought there was going to be a downturn in 2013 or 14. I thought it was going to be in 18, just projecting all the way back, which clearly was wrong. But more because I'm stuck in an asset for 10 years. It's got to be able to do well in a downturn and then get out of there because I'm in there for 10 years, say. It could be longer, it could be shorter. So you got to think way ahead when you're investing in this type of stuff from an LP perspective.
And Dan, let me just jump in really quickly, just on one point to follow up on what Jeremy's saying. At the end of the last recession, I was following a lot of different markets just out of curiosity, even though I wasn't investing there. And one of the things that I noticed was there were certain markets that had the unemployment barely budged, even in the worst of the recession. And those markets tended to have some kind of anchor that wasn't necessarily tied to the economy, like state government or big universities. So places like Charlottesville, Virginia, did really, really well during the recession because that economy is dominated by UVA and it didn't go anywhere. Madison, Wisconsin was like off the charts because it was state government and big state universities. So I think look to those things if you're worried about what's coming.
Great. Well, I have another question that's come in here. For one, Jeremy, you need to compile everything that you're reading as far as your market research that you're doing every day, because we had a couple people are asking, what's his market reading list?
Dan, I used to host a meetup. I started actually co-founded something called For Investors by Investors in 2007 in Southern California. We're nonprofit. The whole core foundation is no sales pitch. And I literally brought over 100 pages of photocopies for every attendee in a roundtable, up to 30 people that I copied on this printer I'm looking at here at home with all the data I was reading. But that only lasted about 4 or 5 years, and I just couldn't handle it anymore. So.
Well, are you guys, so there's a question that's coming in here that has come in here about multifamily and weathering the storm of the economy that is impending that we're all talking about. Can you guys share a couple of the key elements that you would suggest to help weather the storm?
I'll jump in real quick. I mean, the main thing for me that I saw in sort of 2010, 11 was that even people that we gave bridge loans to, we could extend those bridge loans because occupancy went from, let's say, 95% down to 90, maybe even 85% on multifamily property. And so the operator could still service the debt service on deals. What happened on, let's say, an office building or industrial property or even a retail, one tenant would blow out and it would go from 100% down to 75%. And that one tenant, that was all the margin that the operator had in the deal. And so all of a sudden, the general partner was coming out of pocket every month to service the debt service. And those properties came back to us very quickly. And so I would say the number one thing is diversified tenant base is why multifamily can sustain in a recession.
James, this is Jeremy. Just want to add, I think those are really great points. And it's one of the reasons why I'm like hyper diversified in my strategy. So I fully agree with you. One thing I'll add though, is that if you are looking at value add opportunities that are planning to refi, for example, having maybe a 1 to 3 year loan short term that hasn't gone to perm yet, that's another area where you can really have a problem. I think I mentioned it before, but if you're looking at a deal and you're 100% dependent on things going exactly as they're supposed to in like a 6 to 24 month period, and if they don't, please understand that, you know, loans and tranches of construction loans and everything have certain terms associated with them. I saw in 2009 and 10, one after another, again, pulled. So, you know, I actually saw a building near me that was 90% complete, did not have its certificate of occupancy, it was multifamily, it was new construction. And literally all they were missing was the landscaping and a couple of minor things. They couldn't get the last tranche. And 2 years later it was foreclosed, you know, and they were just literally like one step away from the finish line. And this is all because of the loan. And so be very, very cautious, really understand the loan terms, what you're getting involved in, and what the contingency plans are if you're looking at a value add deal, because those are the types of deals that could have a problem if things don't go exactly as planned. Even though multifamily in general, I agree, tends to do very well during a downturn.
Yeah, a lot of people that we work with, if they are more conservative, they are taking sort of non-recourse long-term Fannie Freddie debt. And then if they are doing, if they can either take a supplemental loan or they can sell the property with an assumption and that person can take a supplemental loan. And so you do have a little bit longer leeway or runway, like Dino talked about, just in case it doesn't go perfectly to your 5-year pro forma.
Yeah, and I'll add in. So I had the opportunity, just like I feel honored to be on this esteemed panel, I had the opportunity to meet and network with an operator that has 30 years of experience in the multifamily workforce B and C class housing and over 30,000 doors under his belt. So, and he said, you know, I had a 1% drop in my NOI from 2008 to 2009. I had a 2% drop before that in 2007 to 2008. He said, since then, it has steadily risen and it hasn't stopped. So some words of wisdom that, you know, I believe in, and just coming from someone with that experience, he said, if you buy in the right market, you finance properly, you don't over leverage, you manage it well. This B and C class workforce housing is kind of the theme that a lot of us have been mentioning here. It has the ability to weather the storm, and he's proof of it. So that's, again, just words of wisdom I wanted to share, and things that I'm going to take into account in our firm and what we manage.
Okay. I am going to open up another question here, and it's kind of a twofold question, and I'll kind of condense it down into what I think what they're asking is, do you think if in the next downturn, whether it be this year or 2020 or whenever it is, do you think that the government will step in again and give a stimulus to the economy that would help to, stabilize, the market and keep maybe some of the cap rates steady and occupancy high and various things like that would, mitigate some of the risks that we had back in 2008, because that also happened in 2008 where the stimulus came in as well, or even prior to that.
Just real quick on my end, I mean, I think that's a little bit of the reason why the Fed raised rates in December, was if they kept the federal funds rate as low as it was, they would have they couldn't do anything at that point. And so now that the Fed has a little bit more room, I think I think they would step in. And luckily, 10-year Treasury has pretty much stayed the same. We had a little bit of a run up in November and December last year, and that did scare a few folks. But I do think if there was a greater recession in terms of employment, they would start lowering rates again.
This is Jeremy. I just want to add that I do agree with that in general, but I think it's important to understand that cap rates are not just comprised of interest rate. There's a bunch of factors involved in cap rates. And I want to point out too that, it depends on the asset class, but I like using this as an example because it's a little bit easier to understand. Let's take retail strip centers for a second. Okay, let's say there's an economic downturn. Retailers are not, some people have lost their jobs. There's not as much consumer spending. That means there's not as much demand at stores. That means the retailers, some of them are going to start closing up, or they're going to renegotiate at lower rent rates because their new sales cannot support their previous sales levels. What happens there is that it's like a domino effect, right? And so this has nothing to do with interest rates whatsoever. What happens then is that someone's looking at lower rents, and they're saying, look, prices are coming down. Cap rates are going to adjust because we don't know what's going to happen in the future. We're scared. Consumers aren't spending as much. We don't know that the probability of, or the predictability of that income going forward is a little bit hazy. So we're not going to pay the same multiple. So I'm just giving you a very quick example. There's many. Cap rates are not just about interest rates. So I actually do think that the Fed will eventually step in like they do typically in the downturns and try to help prop things up. I think they're actually more inclined to do it now than they used to be as far as how much they're willing to push with quantitative easing, because it's more accepted now. But the point is that it's not just about interest rates during a downturn. It's about psychology. There's a lot that goes on in the dominoes of a downturn that cause asset prices to shift. And I don't personally think that the Fed can keep cap rates, level necessarily, because there's all these other forces in play, no matter how much they do or don't change interest rates. I think that will have an effect, but there's a lot of other things to look at too. I think it's just important to consider that.
Yeah. And I'll just throw in, I mean, no matter what happens with the market, I mean, it's gonna cycle. There's nothing we can do about it. Everyone has to be prepared and stand where they believe firm and do what they know is right. But we still have the big problem of 4.6 million doors that are needed over the next 12 years. So the market's going to do something in 12 years. And this is coming from the National Apartment Association, the National Multifamily Housing Council. So I think that knowing, with opportunity zones now, with bonus depreciation, with cost segregation, I think they're already tilting it our way and saying, we need help. How can we entice people? So if push comes to shove, I think that someone would have the foresight to step in and say, look, we need to make things right because people need a place to live. And that's just the facts.
And yeah, sorry, Jeremy, just when we were talking about interest rates, I think one thing I failed to mention, and we haven't even said this yet, but when we're looking at 2019, the inverted yield curve in between the federal funds rate and the 10-year treasury. And so almost everything that Fannie and Freddie gives for apartment loans is really based on the 10-year treasury. And so while I think that metric, the 10-year treasury compared to the federal funds rate, got very skinny towards the end of 2018, and it still is. And so there's a lot of concern just sort of as a metric for people to look at. And, I think as people invest in 2019, that's going to be a key thing that they're going to look for.
So last question here. I'm gonna go ahead. We have about 4 minutes left till we're finished with the panel. Last question is from Danny Randazzo, is asking, for those that are not investing in 2019, is the ROI or general return holding them back? And are they expecting 2008 and 2009 big returns still?
I just want to start with something. This is Jeremy. I want to clarify for everybody out there, because I'm hearing this question. I'm seeing another comment from Jay London. I actually still make I've already made a number of investments in this year alone, literally more than one. Granted, I started researching them back in 2018, but just actually made the investments. So I'm always investing in things. The key is that it's got to be a unique opportunity. And I like to say that I look for a 10% or better reduction in pricing compared to true market rates right now to make it unique for me, to make it compelling enough. And so, just to clarify that, even though I call myself sitting on the sidelines, there's always opportunities out there. If your network's big enough, you're going to come across opportunities at any part of the cycle. It's just really, really hard to find them. And so just to answer the other question, Dan, so I would say that, for me, it's not a question of, it's not a question of trying to get the same type of returns we had in the last downturn necessarily. It's a question of just looking at things on a macro level. So here's one thing just to make it really simplified, I'll use an example. If you invested in a really bad property in 2009, 10, or 11, and it wasn't managed well, and you're looking to sell it this year, you actually may be way ahead. If you invested in the best property with the best manager in 2007, and it was managed really well, you may have been foreclosed, depending on the situation. And so timing is really, really key. So when you're looking at a long-term horizon on this, it's not just about what's the ROI this year. Is it, I personally have cash flow targets that I try not to go under to keep me kind of level-headed in terms of not overpaying on a cap rate. But more macro, it's not just about the ROI today. It's about where are we in the cycle, understanding that, and making sure we're not getting in at the wrong timing, so you don't get pummeled because of timing or some other of the issues that we talked about.
Yeah, I'll just follow up on what Jeremy is saying with kind of a real life example, which is we have, one deal that we own still that, it's just one of some deals you have that things just go wrong, right? And this deal has just had everything that you could imagine go wrong. It's just been a parade of horrible. I just, every time my phone rings and I see my manager on my phone, I get this like feeling in my gut because shit, he's calling me about this property again. And it's, but we're going to exit that at a really nice price, right? So the property's performed horribly, but we're just, I could go and tell people I'm a great investor. I foresaw this. No, I underwrote this. I thought it was going to be spinning off cash. None of my underwriting didn't work out at all. But we're going to wind up with really happy investors because of the sale. And that's all because of when we bought it and when we're selling it, we got, frankly, lucky. What I tell people is that if that same thing were to happen, if I were to buy that same deal today and the same things happened, frankly, the deal could perform 50% better than it did on a yearly basis. And we'd probably be getting foreclosed on that deal if we bought now and then anything bad happens in the economy. So the timing is really, really important. I really agree with Jeremy that you really have to be looking at these things long term. and thinking about, not what's going to happen in 2019, but what's in 2020, 2021, 2022, and are you going to be able to survive with this deal? That being said, sort of going back to the original question, am I looking for those kinds of yields in 28, the 2008, 2009 era? Well, yeah, sure. I hope to get those. I hope those are available again. I don't know if they will be, but really the larger point is now the market, those needle in a haystack deals aside, is overvalued, and I just prefer to invest in a time when it's not, when I don't feel like everything has to go perfectly according to plan, but I've got some room for error. Frankly, it's part of building in a margin of safety. I think you don't just build in a margin of safety in terms of the price you pay, but also in terms of sort of where you see things going and what the outlook is. So, that's my answer to that question. I hope it could be a little more precise, but.
Good. So one last thing I'm going to have you guys answer is each one of you just final, maybe one-liner piece of advice that you would give somebody who's considering investing in multifamily in 2019. I'll have you just go with the original order, starting with Jonathan Twombly.
So I am a bear short-term on this asset, but I am a bull long-term on multifamily. I think that it is a great asset to invest in. I think there's a lot of demographic and economic wind behind its back. So this is not all doom and gloom from me. It's really, I wish I could be buying right now because I love this asset class. So just, stick to it, be disciplined, keep your criteria in front of you at all time when you're investing, and don't deviate from it even a centimeter. And that's really the way to go in this market.
Yeah, this is Jeremy. I 100% agree with everything Jonathan said. And I would just add that, be sure if you're looking at multifamily this year that you take a look historically where the cap rates were, how much it's compressed in the exact area you're in, whether it's primary, tertiary, secondary, class A, B, C, whatever it is. Understand where you are in the cycle so that you don't have a problem in the future. So make sure you understand where you stand from historical data and make sure you think ahead. And I basically mirror everything else that Jonathan said.
All right, so final thoughts are, if you are going to invest this year in multifamily, whether it be as an LP or an active syndicator, however it may be, make sure that you stick to your mandates, your underwriting guidelines, just like when we all had to trouble and kind of rack our brains about, multifamily's taken away. What do we do with our money? Do we hold it? Do we do gold? Stuff starts, whatever, mobile homes, whatever it is, make sure that you stick to the mandates and you just don't throw your money at a deal. It's got to be conservatively underwritten. One of the lead GPs, if there's several lead GPs, hopefully they have also been through a cycle. They know what it takes to weather a storm, and buy for cash flow, be patient, stick to your mandates, and ultimately, and this isn't just coming from me, I'm sure. I mean, even Jonathan just said long term, I really like this type of investment. I wish I could be buying right now. So it has the ability to weather the storm if done correctly. Make sure you do it right.
I would say non-recourse fixed rate financing in high quality locations, so you can ride out any downturn. And then also, we've seen in Dallas, there's sort of limited upside on a lot of these deals, and the compression between sort of your A, B, and C cap rates is very small. So if you can buy, a B quality, A minus type asset, qualify for the debt, win the deal, raise the equity, that's where I would be, sort of your B plus, A minus space. And then if you do buy a value add deal, make sure you don't give all the upside to the seller when you close. So a lot of deals, the broker is telling you there's a ton of upside, but after you pay that price, there's not much left for you. So make sure that there's some meat on the bone for you when you sell the asset.
I would say I agree with pretty much all the points that were just made. I would just add that, and this kind of touched on a point we talked about a few minutes ago. If you really are concerned about the market being high and that we're bracing for cooling off or a correction, just bring down your economic occupancy and your projections. I mean, that's one way that if you're trying to underwrite a deal, you don't want to, first of all, pay too much, but second of all, make sure that you don't get hit, depending on what class you're in with a fleeing tenant base, then maybe you underwrite, maybe your typical underwriting, you're at 85% economic occupancy. Maybe you bring it down to 80 or 75. Now, it depends on what your risk tolerance is, obviously, but that is one way that you can, if the deal still makes sense at an 80 or 75 economic, then there's probably a good chance you can weather whatever storm might come. Now, it's not a guarantee, obviously, but it's going to give you that extra buffer of margin so you're not stuck there, presenting a deal to investors where it's like, yeah, we're going to operate at 90. In reality, an economic downturn comes and you've got people that can't pay the rent, they're skipping on units, and you're really, you're operating at 85. So I would say that's one thing that, what we use, if we think that we're buying in, we still think it's a good deal, but we're not sure where the timing is, the market, or maybe we're buying a little too, we're just not completely clear. Again, nobody's got a crystal ball, but that's one thing that you can do. And again, it takes discipline and kind of really knowing your submarket to know what is a realistic economic occupancy number. But if you can put something that's super conservative, that might help you weather the storm if you're at the top.
Well, thank you, everybody, for your comments and your time today. I am very excited about this panel. There's already some great comments. If you're on here and you appreciated this panel and all the thoughts and the feedback, give us a good thumbs up, or I guess you can't do that on here, but give us a yes inside of the chat box there so everybody knows that you're there. Appreciate everybody, for all of you joining us and all of your insights. And looking forward to continuing to follow you guys as we move into 2019. So thank you guys so much for being here. Anything you guys want to follow up as far as questions with them, bring the questions to the MFIN forum and go from there. So thank you guys so much, and I really appreciate your time.
Thank you.
Thank you, Dan.
Thank you.